outlined. ES also took out the Asia high during the London session, so what I'm looking for is whether or not we're going to form some form of SMT here on the highs. Maybe during the morning session relative to the London session, but I'm just going to keep an open mind. If we see that SMT form on the highs and we begin to see the market displace towards the downside, notice that we have a sequence of imbalances here, 2 imbalances to be precise. Pay attention to the highest one in the first place, but keep in mind the lower one. Good morning, everyone. I hope that you are doing well. Welcome to this new trades breakdown lecture. Today, I'm going to take you with me into yesterday's delivery, Tuesday, the 20th of August. First of all, we need to take a look at the daily chart. What we can see is that Nasdaq has traded into this daily volume imbalance price range. During yesterday's review, I outlined to you that right now I did not have a higher time frame draw liquidity for the index futures. The reason why is because we reached or draws on liquidity, and therefore we need to see how the market is going to react to them. What we know is that Nasdaq is currently trading inside this volume imbalance, whilst ES is already trading above this high. That right there is a cracking correlation. Yesterday, during the review, I shared with you that I would be monitoring a very specific element to take place between both Nasdaq and ES during the morning session. What that element was the following. I shared with you that I wanted you to pay attention to the London high during the morning session. If we would sell off from the daily volume imbalance and we would see lower prices get delivered, we would have to see SMT take place on the highs here. If you did not watch the review yet of the 20th of August, I would highly suggest you to do so. What we see here is that Nasdaq created lower highs relative to the London high, this high, during the morning session. If we then pay attention to ES, what we can see is that ES created higher highs. That right there was the sign to me that the time was right for us to likely reprice into this sequence of imbalances on ES. This sequence of imbalances being from this imbalance to this imbalance here, and on Nasdaq from this imbalance right here, the lowest imbalance, to the highest imbalance. This is currently the price range that we're working with. That right there was the drawn liquidity. And what I want you to understand is that the movement higher right here from the 930 opening, which set up the SMT with ES, meaning this movement higher, which caused Nasdaq to fail to make that higher high, whilst ES makes that higher high, and the movement then lower, taking out that low, is a fractal market maker sell model. Let me show that to you. These two candles here, they are one market maker sell model. If we take a look on the 15-minute time frame, it will make more sense to you. Here we're on the 15-minute time frame, and what I want you to see is the following. I want you to see, first of all, how we dropped lower, but in a very slow manner, as you can see here during the golden session, with a lot of back and forth going. 930 comes along, and what does 930 do? It reprices ES towards the upside. It reprices above all of this buy side liquidity. What we then see is that the market forms a high above the London high, whilst Nasdaq does not. That right there is SMT, and we anticipated that SMT to occur because you need to understand that when we have a higher time frame PD array or a higher time frame POI, so to say, or a key level, whatever you want to call it, when we have that key level and we are looking for a reaction of that level, we need to understand that the SMT that takes place, the cracking correlation between Nasdaq and ES, is the signal to us that we're indeed going to trade away from that array on the higher time frame. And that is why I outlined that I was waiting for this. And now pay attention to time. At what time does this 15-minute candle form? At 9:45. What I need you to understand that inside of the delivery from this low to this high, to the candle which eventually closes below the low, we see a market maker sell model on the lower time frames. And if you pay attention to ES, you can see exactly the same. And what do you see? You see that we formed that low in advance of 930, in advance of that drawn liquidity which I outlined, that hourly BC, this price range here. That right there shows that this was engineered sell-side liquidity, and therefore we were only anticipating shorts during the morning session. Now, if we zoom into the lower time frames, what we're going to do is we're going to drop into the 1 minute time frame, and we're going to take a look at the morning session. You guys wanted me to create more raw content, so here we are, but you have to deal with me scrolling like this every now and then, but it is what it is. What I need you to see here on the 1 minute chart is the following. I want you to see how in advance of 930 being right here, we do the following. This black line represents the 930 opening. Same for yes. What I want you to see is that in advance of 930, the market consolidates. you see the market just go back and forth, back and forth, back and forth, back and forth, back and forth. Same for ES, back and forth delivery, as you can see. 9:30 comes along and it does one thing, and that is slam the market higher, as you can see. It begins to reprice higher aggressively. Now, the levels that we're monitoring then during the morning session, the most important liquidity pools are, of course, the London high and low when it comes to session liquidity. As I'm teaching within the model series, pay attention to PXH and PXL. This is all fractal for your info, as you know. Surely, if you're completely new to my mentorship, you don't know how we incorporate time-based liquidity yet into our analysis. But for those of you that have been studying under me for a while, you know the importance of time-based liquidity. Once you understand the importance of PXH and PXL theory, time-based liquidity theory, and you're able to look at these markets through the perspective of, okay, we're taking out a previous cycle low to now draw towards a previous cycle high. A cycle being something which you can determine for yourself, meaning it could be a weekly cycle, it could be a daily cycle, it could be a session cycle, it could be a 90-minute cycle, it could be a 30-minute cycle, it could even be a 10-minute cycle. Doesn't matter. It's up to personal preference. But when you understand that that right there shows the true fractal nature of these markets and how the markets move from PXH to PXL or from PXL to PXH, man, you see the markets for what they truly are. And when you see SMT relative to a PXH or PXL, in this case to a previous session high, the London session high, which we anticipated, and you see the falling take place, that right there is the signature we're looking for. We see the market run up higher here, and who has been making money during that run higher? Longs, of course, buyers. So that is sell-side liquidity, which is being engineered. Why is sell-side liquidity being engineered? Well, everyone, every single retail minded trader, every single average Joe will look at this and think, oh my God, the markets are going to push higher today. From the 9:30 opening, we did nothing but reprice higher. I should go long, I should go buy. I need to call my friends. It's a bullish day for the index futures. And of course, what do we see? Eventually the markets form a high, and at what time does the high form? 9:58. Right here. And if we pay attention to ES, when does the high form on ES? 9:57. That right there is the SMT. It's a 1-minute SMT, which confirmed to us that the high was in during our macro window, and we then saw the market displace lower. What I need you to understand is that a 1-minute SMT is enough, but I want you to investigate this black line right here. ES goes above this black line, whilst Nasdaq does not. That is that London high. And the reason why I want to put so much emphasis on it with you is because this shows that there was a true SMT taking place relative to a previous session high. But if you zoom in into the smart money reversal, into this reversal right here, you see another SMT. And that right there is double SMT, guys. When you see double SMT, man oh man, the chances of you being right, if that occurs during the right time window, with your anticipation of a reversal taking place, they increase significantly. What you then see is that the market displaces lower, trading below this low. Why is this low important? Because this low formed inside of a BC, and therefore the moment that we displace through that low with a CB, we anticipate that we have now changed from a buy program into a sell program. Now, if we pay attention to what occurs inside of this large CB here, what I want you to see is that we see the market trade into that CB here, and we see it distort time. Notice how many times it's providing you with the opportunity to go short. What confirms to us that the time is right for the market to begin to turn around, aka begin to spool towards the downside. There are very specific elements that we can look for within low risk phases of any market maker model. What I want you to see is that if we pay attention to Nasdaq relative to ES, you can see that ES creates lower highs right here. If you pay attention to Nasdaq, however, you can see that Nasdaq creates higher highs. That right there is SMT, which is taking place again. So let me just count up the SMTs for you. London SMT, SMT inside the SMR, SMT inside the low risk phase. That is literally all you need in order to anticipate this right here to occur. Notice how quick the market sold off into what? Into that 9:30 opening again and into this discount BC which formed here. Notice that the market begins to spool towards the downside. It begins to slam lower. This right here is a beautiful algorithmic signature. So done with the intermarket relationship, I want to focus on Nasdaq with you now. If we take a look on this delivery, I'm just going to go into replay here so that I can go into the lower time frames without having to scroll all the way on the 50-second chart to the left. That would be rather annoying. What I want you to see is the following. I want you to see that we formed that high at 9.58 here, and we have that SMT there as I outlined on the 1-minute chart between Nasdaq and ES inside of that larger SMT. Now, if we pay attention to that SMT which is taking place inside of the low-risk cell, let's say that you were not comfortable yet with shorting inside of that low-risk cell, and let's say that you were hesitating with the entry at exactly 108 right here, which is a key time. When that hesitation takes place, you can do one or two things. You can either say, you know what, I'm going to close the charts, I don't even care anymore, I'm not sure what's going to happen, or you do the following. Or you wait for a displacement into the anticipated direction followed by a retracement to provide you with a shorting opportunity. This right here is a beautiful short entry where you see the market displace away from that 1-minute CB, creating a 50-minute CB. Notice what is occurring here. We retrace right here, and then the market begins to slam lower. That right there is the reason why on the 1-minute chart, we did not see any retracement taking place into this CB here. Because this CB is a breakaway gap and there's no reason for the market to revisit that unless this is a slow market. Because there's a lot of speed to be anticipated inside of this market during a macro window, this is again a beautiful entry. IOFET, institutional order flow entry drill, boom, slams it lower. Notice that we have a lot of sell-side liquidity engineered below all of these lows. Look at the trend line that I can draw. Everyone was anticipating higher prices as outlined, and we look to go short against that. This is the liquidity that we require. The market stops right in advance of that 9:30 opening, as you can see here, engineering more sell-side liquidity. Market retraces into this CB here, finds resistance there, and then continues the expansion towards the downside. Now, what I want you to take away from this breakdown is the following. I literally gave you on a silver platter during the review of this day, this delivery right here. I literally said, this is what I'm looking for. I'm waiting for that SMT with the London high. And if that SMT takes place, I'm going to wait for displacement lower. And then I anticipate the market to swap towards those objectives. That is how precise these concepts are, guys. And this is all occurring during the macro windows. And I know that for some of you that are completely new to studying the markets through this perspective and looking at them from this perspective, I know that it might seem like, you know what, it's probably lucky. It's probably just one of those instances. Guys, these signatures occur every single week, multiple times. And how many times do you need to capture a move like this in which you're able to, let's say, capture 100 points on the Nasdaq? Be honest with me. How many times a week would you need a move like that in order for you to be deemed a good trader for yourself? Start putting realistic expectations in your mind. Don't think that you need to be out here trading every single day, every single session, every single minor fluctuation, and every single minor setup that you might see. Focus on determining the highest probability setups. The highest probability setups are when you make an analysis hours in advance of the market open, and you literally say, okay, I'm going to look for this and this during the morning session because that is what I'm anticipating. And when you then see all of the variables be checked during that morning session, for example, that London SMT during the right time window, SMR, fractal SMR, SMT, etc. When you see all those variables being checked and you see exactly what we're looking for according to what I'm teaching you within the model series during the right time, everything is aligned. That right there is a high probability setup. A high probability setup is not simply a break and a fair value gap and you think, oh, look, it's a price pattern or an inversion fair value gap. Look, we trade above a CB, now we should go lower. No, guys. It's when everything is aligned. Like, do you understand how hard you are making it for yourself? you understand that this is how one should trade, but still you're chasing patterns. Still you're going out there and thinking to yourself, okay, I don't know why you're thinking this. It's probably because you have ideas in your mind of what you deem to be good trading. You deem good trading that you take multiple trades a day and that you're able to capture the exact lows or highs and that you're able to show that off to the world or whatever. Guys, that is not realistic. Based on what you know now, you should be able to find at least 1 to 2 setups every week in which all of these criteria are met. Do you need more than that? No, you don't. So stop thinking that you need more. And then what I want you to understand is as well is that when this move is done, when this expansion is done, be content with that. Don't think, okay, I need to be out here. Okay, I just went short. Let's now look for longs. Why? Be content with the fact that you took that move. Later during the lunch session, I recorded a small video for the Telegram channel in which I said, okay, we're going to reprice higher during the lunch session, or during the lunch cycle, I should say, during the lunch macro. And I'm going to break that down for you as well, because what I want you to understand is that there are so many freaking opportunities each day. But that doesn't mean you should be out there trading every single freaking opportunity. Only opportunities that we look to trade are the opportunities that we deem high probable, that we know should deliver because our higher time frame analysis suggests that it should be delivered. What I want you to understand is that we can literally set our clocks to these opportunities. We can literally wait for a specific moment of the day, look for specific algorithmic signatures, and boom, there we go. If we pay attention to this delivery, what I want you to see is the following. I'm going to pay attention to the 11:30 open right here, which is the open of the lunch cycle as I'm teaching it to you. I'm also going to be paying attention to the 10 o'clock open for a moment. What I want you to see is that during 10 to 11:30, the market did the following. We repriced towards the downside aggressively, as you can see. This is the range of that previous cycle. If we anticipate a retracement to take place, how deep can we anticipate the retracement to take place? When the time is right, we can anticipate the market to seek to retrace into equilibrium of the previous range. Let me just annotate equilibrium of the previous range. What do you see? Equilibrium of the previous range lines up with the high of that hourly imbalance, as I've annotated by this blue box. When I see this, my eye goes immediately to the nearest buy-side liquidity pool. The nearest buy-side liquidity pool is above these relatively equal highs here. Now, what I was anticipating was for the lunch macro to draw towards these relatively equal highs. And when they got reached, I shared with you, okay, this is time to take a big partial. And what I want you to understand is that even though I saw this move coming, even though I saw that we would likely draw towards these highs here, because the lunch marker was likely going to reprice into equilibrium of the previous range, I did not take this trade. And why did I not take the trade? Because I had absolutely no interest in taking it. Why not? Because to me, what I do is the following. I focus on one high probability setup. And when that high probability setup is done, it's done. Meaning I don't look to do more. I don't look to go out there and try to dance on these markets. No. Even though I see the move occurring, I know that it is better for me to just stay out and wait for the next high probability setup, which is completely in line with high time frame order flow. When a key market move has delivered, what I've learned over the years is that it's better for me to simply wait. Just wait and see how are they going to deliver now. This means that I read the tape when I see a new opportunity present itself. And that is why I also shared that video with you. When I saw this move likely taking place, I wanted to really make sure that I was able to basically share in advance why the market should reprice towards the upside. And what I shared within that video was the following. Do you see these relatively equal lows here? You might look at them and think, oh, that's engineered sell side. That is likely sell side liquidity which we're going to take out. Yes, you're correct in thinking that. But, here comes a big but, you need to understand that the sell side liquidity can only be attacked or taken out when the time is right for the market to reprice lower. Until the time is right for the market to reprice lower, we can anticipate the following to take place. If we pay attention to this delivery here, What I need you to see is the following. At exactly 10:43 here, right in advance of our macro window, we formed this low. Notice how the market then displaced higher above this upclose candle. If I extend this upclose candle to the right, you can see how many times that upclose candle functioned as support on price. This consolidation, which is taking place inside of this upclose candle, is time distortion to me. Meaning, I'm looking at through the lens of, okay, smart money is going long inside of this delivery. Why? Because they know that this upclose candle has to function as support on price and the market has to draw towards buy side liquidity next during the upcoming time window. When we understand that, our job is to enter when the time is right for the market to begin to expand. The time was not right anytime in this area. The time was right when significant SMT took place. SMT is way more powerful than you currently think. What I need you to see is the following. If we pay attention to ES, and we look at ES's respective delivery, let me just go here, and we zoom out, what I want you to see is that if we put a vertical line at 11:30, which is the open of our 90-minute cycle for the lunch session, see the following. We can see that ES trades a lower low here during that cycle, whilst Nasdaq also trades a lower low. You see it? Here. But if you pay attention to that previous cycle low for ES, the previous cycle low being right here next to it, you see it? At 11:29, we form this small low. If you look at that low, and you look at it from this perspective of, okay, that is the low of the previous cycle, I'm going to see if we're going to see SMT relative to that previous cycle low or high. What I need you to see is that there's an SMT relative to this low right here on Nasdaq. Because Nasdaq formed its previous cycle low here. It doesn't matter that there was already SMT here. Why not? Because all that matters is that during 10 to 11:30, we form a higher low, our eye is drawn to the low and high, and see whether or not a correct correlation will take place during the next time cycle relative to that low. So what do you see? You see that ES creates a lower low, whilst Nasdaq creates a higher low. At exactly 11:45, we see this take place, market forms a low, and notice that we do not trade below that 11:45 low. Bullish order block forms right here, and the market begins to expand towards the upside. This CB is not a CB to go short in. Again, this is where pattern traders fail, because they do not understand the overall logic behind setups. They would go short inside of this CB thinking, oh, we went lower here, look at the CB, we took out buy side liquidity here, therefore this is a short. No, why not? Because narrative goes way deeper than simply looking for a price pattern where we take out the high and then see a CB form. That's not it. What we then see is that the market utilizes this CB as an inversion for value gap on the lower time frames. Market trades above that 9:30 open, finds support inside of that, and then begins to expand towards the upside. How many minutes did it take for the market to reprice from this low to this target? Let's take a look. At exactly 11:45, we formed this low, and at exactly 12 o'clock, we took out the high. That was the drawn liquidity. That means within 15 minutes, the market delivered from this low to this high. You tell me, if you would catch one move like that a day, or let's say a session, wouldn't that be more than enough? Guys, this is literally how you can make a shit ton of money within 15 minutes of your time. But here comes the thing. When you take this trade, you would think to yourself, well, if I'm able to do this so many times a day, if these opportunities present themselves so many times a day, does that mean I should be trading every single opportunity? No. Because like I outlined, all that matters is capturing the highest probability setups. It doesn't matter how many setups you see every single day. Only take the setups that are completely in sync with a higher time frame idea. And trust me, you are going to see the results that you're desiring to achieve. Because you know that you are holding yourself back by taking C+ setups. Focus on the A+ setups. And that is what I want you to begin focusing on moving forward. I literally outlined that this move would occur in advance and you did not see me press any buttons. Why not? Because I know that if I would take this trade and it would in fact run in my favor, for a moment I might think, look, I'm happy with that. Look, my analysis is correct. My concepts speak with such clarity to me and therefore it's good, right? And then I would look at it in hindsight and reflect on it and I would think to myself, I should have not taken that trade because I was already in big profits for the day. At some point, guys, your performance tracker, the protocol that you're adhering to, has to include rules that limit yourself. That literally say to yourself, okay, enough is enough. I'm not going to do more than that. Because if you try to do more than that, if you try to do more than is required, and you try to go out there and push it, so to say, that right there is actually counterproductive. What is more productive is focusing on that high probability setup, taking it when the drawing liquidity gets met, done. Don't try to do more. Wait for the next high probability setup to come, which is in line with a higher time frame idea. That right there, guys, is what I want you to take away from this lecture. I broke down a beautiful short to you, a beautiful textbook market maker sell model according to the rules that I'm teaching you. And then I also showcase to you the logic which could have been utilized to go long instead of this leg higher during the lunch macro. Why would lunch likely draw towards buy side liquidity, you might be wondering? Well, what I want you to see is that since 10 o'clock, yes, we repriced heavily towards the downside. The market had this large range towards the downside. Who has been making money throughout that large range expansion towards the downside? Sellers, of course. So what liquidity has been engineered? Buy side liquidity. Therefore, the launch macro will seek to draw towards that engineered buy side liquidity. And that lines up with a premium of that previous cycle range, as you can see, from the high to the low, equilibrium being right here, relatively equal highs being engineered up here. Therefore, when the time is right, being confirmed by SMT right here, that shows to us that we're likely now going to expand towards buy side liquidity. And what we then see afterwards is the following. Market begins to slowly grind towards the downside, and that is when that sell side liquidity was allowed to be taken out. I did not look at the afternoon session because I was already content with enough and I wanted to spend some time with family. Now, what I want you to see when it comes to this delivery, final piece of sauce for you for this lecture, is the following. What I want you to see is that we have that high of that ROE imbalance right here. Notice how we close above it and the next candle opens up, offers sell side into that high and then immediately expands towards the upside. That right there is an algorithmic signature that is very important for you to understand because it shows the importance of higher time frame levels, of higher time frame imbalances. And when you pay attention, what do you see? You see that we have a smaller CB right here lining up with that. That right there is an inversion to value gap. And when you see imbalances form inside of higher time frame imbalances, that is something I want you to pay attention to. And the reason why I managed the position in hypothetical position, of course, because I was not trading it, but the reason why I mentioned that the trail stop would now be here, if the entry was inside of this bullish order block, was due to the following. Notice how we took out this high right here, the drawn liquidity, begin to consolidate. We have this large BC here, which formed first of all. If that BC does not function as support on price and we see the market gravitate towards the upside, that to me is already a warning sign. If we then see the market displace below that CB, which I outlined right here, that is again a warning sign. But if we also then displace below this upclose candle, which was a bullish breaker, why? Because we have a low, high, lower low, then you have literally all the signs that you need to see in order to say, okay, we're really not going to continue higher, walk away. That is trade management. That is how we trail our positions. And that right there is something that you need to begin paying attention to. Because imagine being long in this area, seeing the market reach a strong liquidity, taking a partial, and then allowing the market to gravitate all the way to your entry. Is that efficient risk management? Of course it isn't. That is why we trail our stops, and that is why I'm teaching you how to do so. So with that, this lecture comes to an end. It has already been probably a long one, but I hope that you found it insightful. And I want to wish you good luck, good trading today, and look forward to catching up with you soon. Be safe.